Our financial experts, by and large, have been expounding how great our economy is and what a perfect time it is to get in there and buy. Buy now, buy now, V-shaped bottom, V-shaped bottom, buy now, buy. First they told you, no, there won't be a housing bubble. House prices are just going to keep moving on up. Then, well, okay, so yes, there was a housing bubble, and it kind of burst, but that doesn't mean we're entering into a recession. And then, well, maybe okay, we're in a recession, but it's going to be a mild recession, and it'll all be over in a few months or so. And then it was like, well, okay, so the recession is a little bit deeper than we previously thought, but it won't be a protracted recession. And then, yes, well, okay, so it's deep and protracted, but there's no way that this thing is going to turn into a depression. That's just crazy talk. And now, finally, our financial wizards are all in agreement. So we're in a depression, but this is your garden variety depression. There's no way this is going to turn into a Great Depression. Let's hope they're finally right about something. In what could be the biggest news story of all time, reported nowhere on television news and swept into a corner where no one would ever come across it, Bloomberg reports on a crisis in the making. According to Bloomberg, March 4th, 2009, FDIC's Bear says insurance fund could be insolvent this year. Federal Deposit Insurance Corp., yes, that corporation that ensures that should your bank collapse, that your money will be refunded, Chairman Sheila Bair said that the Deposit Insurance Fund could dry up amid a surge in bank failures, as she responded to an industry outcry against new fees approved by the agency. Without these assessments, read price increases for banking insurance, the Deposit Insurance Fund could become insolvent this year, Bair wrote in a March 2nd letter to the industry. U.S. community banks plan to flood the FDIC with about 5,000 letters in protest of the fees, according to a trade group. A, quote, large number of bank failures may occur through 2010 because of rapidly deteriorating economic conditions, Bair said in the letter. Without substantial amounts of additional assessment revenue in the near future, read price increases for banking insurance, current projections indicate that the fund balance would approach zero or even become negative. The FDIC last week approved a one-time emergency fee and other assessment increases on the industry to rebuild a fund to repay customers for deposits of as much as $250,000 when a bank fails. The fees opposed by the industry may generate $27 billion this year after the fund fell to $18.9 billion in the fourth quarter from $34.6 billion in the previous period, the FDIC said. The fund, which lost $33.5 billion in 2008, was drained by 25 bank failures last year. 16 banks have failed so far this year, further straining the fund. So let me get this straight. 25 banks failed last year, and already this year 16 banks have failed? I'll let you read the remainder of the article for yourself, but consider this. If banks teetering on the brink of collapse are suddenly asked to pay additional fees to the FDIC, will they be the next to fail? If so, won't this simply create a positive feedback loop from which there is no escape? Fees go up, the number of solvent banks goes down, the funding for the FDIC falls short, and fees go up. The number of solvent banks goes down. On the other hand, if the FDIC doesn't receive these funds when banks do fail, there will be no FDIC to bail out the customers, and all of their savings will go up in smoke. Can you say crisis yet, or do you need to head back to the boob tube and see what the land of Oz has to say?